Okay, good afternoon friends. Let's just revise what we have done in capital budgeting till now. We started with understanding the 6 techniques which were there, that is your NPV, IRR, ARR, payback, discounted payback and profitability index. We understood how all the 6 techniques work. That's predominantly what you do at IPCC level. So we had done one problem, in fact 2 problems on that to understand the 6 techniques of capital budgeting. After understanding the 6 techniques of capital budgeting, in fact third and the fourth problem was pretty much similar. The later part of the first session, the first class which we had on capital budgeting, we were indicating what steps do we follow, what are the rules in capital budgeting. So let's summarize them. As far as steps is concerned, we will follow 4 steps. Step 1 is initial outflow. The initial outflow can be for fixed assets, which is called as capital expenditure. It can also be for current assets, which is called as working capital. So 2 parts of initial outflow will be there. One is capital expenditure, second is working capital. After doing initial outflow, we have in between flows, which can start with increase in revenues / decrease in cost. Both are inflow for the company. So revenues less all expenses other than depreciation, PBDT less depreciation, PBT less tax, PAT, add back depreciation, CFAT. CFAT gets adjusted for multiple items, the items which were increase or decrease in current working capital, payment for original machine or purchase of any additional machine, and then we used to get the revised cash flow. Step 3 was terminal flow, which is there will be a working capital which gets released. We technically call it as recapture of working capital, and a net salvage value of the asset, which is there is a difference between salvage value and net salvage value. Salvage value is the value which comes out of by selling the asset. Net salvage value is post considering the tax impact on it, because when you sell you can have a capital gain or a capital loss. On that either you pay tax or save tax. We also learnt about certain rules which were there. We said that we will have to consider only relevant cost, consider opportunity cost, ignore all sunk costs, ignore apportioned overheads, ignore general overheads, ignore corporate overheads, consider reward exclusion principle, which said that any reward which is paid to the providers of money, that is interest as well as dividend, will get ignored in our analysis. All of this we had learnt in the last class. Today we are going to do few problems to test that understanding. Let's go with question 5 today. ABC Limited is considering whether to invest in a project which would entail immediate expenditure on capital equipment of 40,000. Feasibility study at a cost of 8,000 indicates the following expected sales. So this is what the sales we expect out of the product. Once sales are established at a certain volume in the first year, the same will continue for subsequent years. Selling price, variable cost is given, certain fixed costs are given. The project will have a life of 6 years, after which the equipment would be sold as scrap, which would fetch 3,000. The cost of capital you are required to find out, NPV of the project, minimum volume of sales per annum required to justify the project. 2 parts to the question, just go through this. This is page 180, question 5. Okay. let's start with this. I am required to finally calculate NPV of the project. We will go through 4 steps: initial outflow, in between flow, terminal flow, consolidate and calculate NPV. We will see what is to be done with the rework. Working note 1, initial outflow. Working note 1, initial outflow. Initial outflow. Working note 1, initial outflow, particulars and amount. Particulars and amount. Initial outflow, particulars and amount. First line item, capital expenditure. Capital expenditure. Capital expenditure. The same steps will follow most of the question. What is the capex to do this project? How much? 40,000. Capital expenditure 40,000. Negative. Negative 40,000. Capital expenditure is negative 40,000. Point number 2, working capital. Working capital. Any information on any working capital requirements? If nothing is there, we will write 0. Some question may indicate. There is no information on working capital, 0. Working capital is 0. Point number 3 is feasibility study. There is a feasibility study which is done on day 0. There is a feasibility study which is done on day 0. Point number 3 is feasibility study. How much is the feasibility study? 8,000. Is it relevant or irrelevant? It's an irrelevant expense because it is already incurred by the company. We are deciding whether to invest in the project or not, and the feasibility study is already done. Once you are done with the feasibility study, it becomes a sunk cost. If you are already done with the feasibility study, so feasibility study in bracket sunk cost, feasibility study in bracket sunk cost 0. This is the total outflow. Sunk cost is something which is already incurred. If you have already, before buying a movie ticket, before I buy a movie ticket, it's a relevant cost. The moment you have bought the movie ticket, you have made the payment, the cost of a movie ticket is sunk because you have already incurred it. You cannot go ahead and now say, I want to cancel this movie ticket. It's not possible. Whether I go to the movie or I don't go for the movie now, the moment I have booked a movie, if somebody has already booked a movie and now is deciding whether to go to the movie or not, the cost incurred by him to go to the movie is 0 because you have already booked the ticket. After booking the ticket, the value of the ticket is 0 unless you find that there is a person who can buy it. Unless if you feel somebody is ready to buy it, then that is the value of the ticket. So, sunk cost is feasibility study is already done. Now, the value of that report is 0 for me because the report has already come in.
Then any expenditure can become sunk cost.
Yes, the moment you incur it, it becomes a sunk cost, that's all. Assume, for example, this classes you come. Assume you don't have an option of cancelling our classes and you register for the classes and suddenly you think that you want to go for some other classes. This is a sunk cost, that's all. You cannot think now, I've already paid 10,000, I'm paying more now for the other classes, that and all will not work. Because this is already paid, that's all, it's a sunk cost now. You cannot get anything out of this, you cannot get anything back. So, moment you have incurred, a lot of things, no, in practical world, if you have already paid for something, whether you, air ticket, now if I cancel the air ticket, I'm not going to get anything out of it. So, it's a sunk cost, that's all. I cannot do much about it. So, feasibility study, sunk cost, amount is 40,000, your initial outflow is 40,000. Working note 2, in between flows. Working note 2, in between flows, particulars and amount. Listen, when I do in between flows, we will have 2 types of problem. One problem where I will write particulars year 1, year 2, year 3, year 4, year 5, year 6 separately because the calculation will be different for different years. Some year you sell 5,000, some year you sell 10,000, some year you sell 12,000. In this question what they have said is, whatever happens in the first year, once sales are established at a certain volume in the first year, they will continue at the same level in subsequent years. So the volume is not going to change moment the sale volume is fixed. Now it can be 2, it can be 6, 8, 10, 14. What we are going to do is we are going to take a weighted average of this, because I have the probability. Expected sales volume is the weighted average of the sales volume with probability being the assigned weight. In the calculator, 0.10 into 2000 equal to m plus, do a weighted average. 0.25 into 6000 equal to m plus. 0.10 into 2000, 0.25 into 6000, 0.40 into 8000. You will do a weighted average and get one volume. How much? Okay, so that is the units which we are going to sell. Units are expected sales volume. Expected sales volume is 7,800 units. I am expected to sell 7,800 units is what we are expected to sell, taking a weighted average. This concept we have done at multiple places in a portfolio. At other places also we have done, so we take a weighted average of it. Any doubts on this? Okay, when I do my step 2, one critical information is the problem having tax or no tax? Do we see tax? Okay, now if I don't see tax, I have two options. One, I will say taxes are ignored. Second, I will say taxes have been assumed at 30%, which is the general corporate tax rate. Your assumption, whatever you want to take. In this problem, I am going to ignore tax. The moment I ignore tax, revenues less all cost will give me PBDT. That PBDT is CFAT. PBDT and CFAT will remain same. Why do they remain same? Because after PBDT, you deduct depreciation, you deduct tax. Tax is 0 anyway. You add back depreciation. So indirectly, you go back to the same amount. So if taxes are ignored, then PBDT is otherwise called as CFAT. So I have expected volume, revenues. The selling price would have been given in the question. Revenues. What's the selling price? 10. So revenues is 78,000. Revenues 78,000. 7,800 into 10 less variable cost 7,800 into 6. We could have directly written contribution also. I could have done into 4 and written contribution. Variable cost is 7,800 into 6. Any doubts on this? Okay. After getting the variable cost, I have to go to fixed cost. Now listen, we will have to read, is this a relevant or an irrelevant expense? Read this and let me know. Rent. Relevant means I will subtract it, otherwise I will ignore it. It is relevant because I am going to incur this only if this product is manufactured. To identify something as relevant or irrelevant, decision yes, no. If you do this project, pay 10,000 rent. If you don't do this project, pay 0 rent, because they are saying rent would be payable only as long as the new product is manufactured. Listen for some time. Head office expense. If you do this project, they will apportion 10,000. If you don't do, they will apportion it to some other place, because my head office expense will be incurred. The head office is in Chennai, they will continue to incur. If my project is there, they put 10,000 to this. If my project is not there, they will put 11,000 to some 9 other projects. So indirectly the company is going to incur. So this is a irrelevant. Now you see this other expense of 10,000, it's your assumption. In costing, the assumption is all fixed costs are irrelevant unless provided otherwise. So if you don't give me extra information, I treat it as irrelevant. Here I can say other expenses in bracket to be incurred are generic in nature. If it is going to be a specific fixed cost, it's a relevant expense. If it's a general fixed cost, it's an irrelevant fixed cost. So that is up to us what to decide. This is assumption based, relevant, irrelevant. The first item is relevant, the second item is irrelevant, the third item is it's my choice. How do I want to treat it? Because without extra information I cannot tell it. Costing we normally consider irrelevant. I think in this they have considered as relevant. So we'll move it as relevant by making an assumption saying that other expenses, listen. When you have to write something as relevant, what you will write is other expenses in bracket to be incurred. This is something which will be incurred. If this is a committed, for example, if Bharadwaj Institute is thinking that we will provide one more course in this building, the rent cost for that course is 0, because anyway I am already paying the rent. I am paying that rent because CA classes is already going on. So CA classes go in the morning. Let's assume we decide to do some classes in the afternoon. When I am trying to do that, if I do my costing, the rent expense for that is 0. I cannot write a rent expense because I am doing classes in the afternoon, because I am not paying anything extra because of that. What will be relevant? The electricity expense could be relevant because that is something which is extra incurred. The faculty cost could be relevant, but rent can't become a relevant cost. My administration, they do marketing, they do administration, they take care of everything. Their cost is not going to change. If the cost is not going to change, any new course which I am providing, logically speaking, the cost only, the variable cost only will become relevant. Why electricity becomes a relevant cost is this is kind of variable, because you are going to switch on lights, you are going to switch on AC, and then you are incurring it. Practically speaking, all fixed costs are irrelevant. All fixed costs are irrelevant. Now I cannot be telling that if I am providing a new course and saying that I am paying so much rent, why don't I recover, why don't I recover? If I think that way and start pricing it higher, what will happen is, if the course is not happening, anyway the rent will be the same and I at least miss out on it. So practically what they say is, they look at only at a contribution level. Our analysis gets restricted to a contribution level, and we see that how much does it contribute towards recovery of fixed cost. So CA course will contribute towards recovery of rent. CS will also contribute towards recovery of rent. Some other course which I provide will also contribute towards recovery of rent, because variable cost is specific to that, but fixed costs are always general in nature. So this other expenses, I am making an assumption that this will be specifically incurred for this project. So now write less rent 10,000, rent 10,000, less head office expense, irrelevant in brackets, head office expense irrelevant in brackets, 0, head office expense irrelevant, less, I think we have one more thing which was other expenses in bracket to be incurred. This is my specific assumption which I am taking, saying that this will be incurred by the company. To be incurred, other expenses to be incurred. I am not getting to the depreciation level because depreciation is not needed, as we are not going to calculate tax. Depreciation is needed only when we calculate tax. In this problem, we are not going to calculate tax. So this is called as PBDT/CFAT. PBDT/CFAT. No tax calculation in this problem. PBDT/CFAT. PBDT/CFAT. Major bulk of the analysis will focus on relevant costing, which you will learn in cost accounting. That is where you will learn about relevant costing, and that will keep coming here. PBDT/CFAT is 11,200. Clear? Working note 3, terminal flow. Working note 3, terminal flow. Particulars and amount. Working note 3, terminal flow, particulars and amount. Particulars and amount. Point number 1, net salvage value. Net salvage value. See, on day 1, two things get stuck. One is current assets, second is fixed assets. On fixed assets, we get salvage value. On current assets, that's a recapture of working capital. What is the salvage value of this asset? 3,000. Now, I am not going to do any comparison with book value because taxes are not there. In this problem, I don't have any tax. So, salvage value is equal to net salvage value. Otherwise, sale value less book value, gain or loss, tax paid or tax saved. So, net salvage value is 3,000. Recapture of working capital. We technically call it as recapture of working capital. I am capturing it back. Recapture of working capital is 0. Any money which gets stuck on day 0 will get released. So, when I have working capital, I will explain there. In this problem, we didn't have working capital. Whatever money gets blocked in raw material, in cash, in debtor on day 0 will get blocked because project is over. When I am running a shop, I have inventory. On the last day when I close my shop, if I am winding up the operations, I will get back that money. Practically, you may not get back the entire amount because you may have to do some discount sale, all of that will happen. But in a problem, we take it as the same amount. Whatever gets blocked gets released back. Let us see when we have a working capital problem. Now, after calculating the cash flows, the cash flow calculation is the most important part. After calculating it, consolidation of cash flow and calculation of NPV. You can even write it as calculation of NPV. It's basically we are going to take figures from each working note. Consolidation of cash flows and calculation of NPV. Consolidation of cash flows and calculation of NPV. Year cash flow PVF. What is the cost of capital given? PVF at 10% and DCF. Year cash flow PVF at 10% and DCF. Year cash flow PVF at 10% and DCF. Year cash flow PVF. Year 0. Go to step 1 and tell me the figure. Minus 40,000. Minus 40,000. 1 to 6. I can even write 1 to 5 or I can write 1 to 6. 1 to 6 is how much was the in between? 11 and 6 separately 3,000. 1 to 6 is 11,200 and year 6 separately is 3,000. Or you write 1 to 5 11,200 and year 6 will be 14,200 then. The last year will be 11,200 plus 3,000. Year 0 40,000 outflow. You get a 6-year annuity factor in the calculator. 1 divided by 1.1 equal to m plus 6 times 4.355. This was one. Last year was how much? 5.64. Post multiplication you can round off. This is the NPV of project 10,468. 1 divided by 1.1 equal to m plus equal to m plus 6 times. If you repeat, you will get the annuity factor. 6 times you will get the annuity factor.
So here the feasibility study is a sunk cost.
Sunk cost, yes. Any doubts on this? Any doubts on the NPV of the project? So the NPV of the project is 10,468. That was the first part of the question. Expected value of the NPV of the project. Why it is called as expected? Because we did probability analysis in this. So the NPV is 10,468. Minimum volume of sales per annum required to justify the project. How should I do this and what are they asking in this? Minimum volume of sales required to justify the project. NPV should be technically 0. So NPV should be 0. So what we will do is, listen, I'll recreate this table separately now. I need a NPV of 0. Listen for some time. You can fill a figure here. You can fill a figure here. You need a NPV of 0. After getting this number, you will go back here saying that you don't need 11,200, you need something else now. You don't need 11,200, you need something else now. This will be 10,000, 0, 10,000. Your revenues will be 10x and variable cost will be 6x. Variable cost will be 6x. Revenues is going to be 10x and variable cost is going to be 6x. You have the other expenses. This is equal to some number. We are going to get to some number. Clear? Able to understand this? Justify the project is basically at a 0 NPV. If I get 0 NPV, that's the minimum volume which I need for a project to happen. Positive is great, but minimum 0 is needed. Next, right? Next working note, calculation of minimum volume. Calculation of minimum volume to justify the project. Calculation of minimum volume to justify the project. Calculation of minimum volume to justify the project. First let's recreate this table. Year, cash flow, PV of DCF. Let's recreate. Write first few points. Point number one. The project will get accepted. The project will get accepted if it has positive NPV. If it has positive NPV. If it has positive NPV. Full stop. We should find the volume. We should find the volume at which the project will have. We should find the volume at which the project will have 0 NPV. We should find the volume at which the project will have 0 NPV. Next point, the cash flow at which the project has 0 NPV is calculated below. The cash flow at which the project has 0 NPV is calculated below. Do this and let me know what cash flow will give 0 NPV. Cash flow which leads to 0 NPV. Same table. Cash flow which leads to 0 NPV. 8,796. 8,796. Any doubts on 8796? Can you proceed? Next point, right? The project needs annual CFAT of 8796, annual CFAT of 8796, annual CFAT of 8796, full stop. We incur fixed cost of 20,000. We incur fixed cost of 20,000, and hence target contribution is 28,796. Target contribution is 28,796. I need a profit of 8,796. Fixed cost is 20,000. Target contribution is 28,796. Hence the target contribution is 28,796. Listen, contribution per unit, listen for a minute, is 4, and units to be sold is this divided by 4. 7199 units I have to sell to have a break even. We worked with 7,800, but 7199 is the minimum volume. I can also assume X and do, I'll get the same answer. I need a profit of 8796, which means I need a contribution of 28,796. To get a contribution of 28,796, we need to sell 7199 units. We should sell 7199 units. 7199 units. That's the number of units we need to sell. If I put 7199 in my calculation here itself, whatever we have done, if I put 7199, it will become 7199 into 10, 7199 into 6, and I get PBDT of 8796. I'll get PBDT of 8796. I know the profit, I add back the fixed cost, I get to know what contribution is needed, we divide that by 4 and we get to the number of units, which is 7199 units. Any doubts on this? So with the volume of 7199 units, I'll be okay to do this project. So minimum is 7,200. If I get 7,200, I'm perfectly fine with this project. Anything less than 7,200 will not be a viable one. Any doubts on this? Okay. Let's go through question number 6. Major chunk of it I'll tell you to copy it, some part I'll tell you to calculate. Go through question 6. Okay, now listen. See, there are two techniques by which a project gets evaluated. One is NPV and second is IRR. There is an inherent assumption which says that NPV says that whatever cash flows we are getting. Now listen, I'll do bulk of the calculation, I'll tell you to copy. Some part I'll tell you to do the calculation. let's, if I take project X, can you just tell me the cash flow numbers? First year 110, 31, 40, 70, 70. What is the cost of capital they have given? 10%. I'll tell you to note it down in some time, whatever is critical. So this will be the NPV of the project. If I do the calculation, this is the NPV of the project. I don't want you to do IRR calculation, it will take a lot of time, but if I do IRR calculation, this will give me the IRR answer. I have written the cash flows, I'll get the IRR. So the IRR in this case was 22.61. We have the other project. What was the cash flows for the other project? First year 110,
71,
40,
40. So 71, 40, 40, 20.
20. Okay. Now if you see, this is better NPV. This is better IRR. This leads to a conflict. To resolve the conflict, one, I see whether the life is different. If life is different, we'll learn something later on called as EAB or EAC. You could have, this was part of CA Inter, if you remember, there is an equated annual benefit and equated annual cost. But if life is same, then I have something called as a reinvestment rate which comes into picture. Technically, what happens is when IRR is 22%, when you calculate 22, IRR says this 31, 40 and all you are seeing, no, you are able to reinvest them. You are going to do some other project, and in that project you are able to reinvest at the rate of 22.61%. That is an implied assumption of IRR. IRR says that any money which comes in will be reinvested at the rate of 22.61%. I think in bond valuation, did we do reinvestment assumptions? One problem. So we had done realized YTM. We would have done something called as a realized YTM. Now what does, listen, IRR assumption, NPV assumption. What IRR says is that this 31 will get reinvested at 1.2261 into 1.2261 into 1.2261. That is 3 years you will reinvest at the rate of 22.61%. This cash flow will be reinvested again. This calculation at all is not required. This is only to understand the concept. Last year you get the same amount and you put a total of this. So instead of receiving one money, if I receive at the end of the project, it's 248. Instead of receiving a single money, if I receive it at the end, it is 248. What NPV says is this will get reinvested at only 1.1. That is your cost of capital. It will get reinvested at cost of capital. So both have a separate assumption. Both have like this. I can do it for the other project also. Everything has an assumption. Now just give me. See, NPV has been calculated by thinking that you reinvest at 10% and in the 4th year you will get only 214.661. That's an assumption of NPV. NPV says all cash flows will get reinvested at cost of capital. If you reinvest and at 10%, you see the NPV, same 36.58. You see the same 36.58. IRR says no, it's not 214.611. It will be 248.578. If you see that, you get the same IRR, 22.61%. You will get the same IRR if you have an option of reinvesting it at 22. You will get the same NPV if you have an option of reinvesting it at 10%. Now I don't know the real reinvestment rate which the company has. I need to find what is the reinvestment rate company is looking at. After finding the reinvestment rate, I do the analysis, both the projects will give the same result. See, this part should be very clear to you, how to calculate NPV, how to calculate IRR is known to you, so we know these two numbers. An assumption of IRR is that whatever you get will get reinvested at 22.61%. So what I get in first year will increase by 22.61%, will further increase by 22.61%, will further increase by 22.61%, and you will get this number in the fourth year. This in the fourth year, this in the fourth year. So you will keep doing this as far as IRR is concerned. IRR says reinvestment will happen at 22.61%. NPV says reinvestment will happen at 10%. Now logically speaking, both can be incorrect. Both can be incorrect because I want to know what is the company looking at. So we will find the reinvestment rate which the company is looking at. The moment I make that reinvestment assumption, both NPV and IRR will choose the same project. Both NPV and IRR will choose the same project, and that NPV and IRR which you calculate is called as modified NPV and modified IRR. Whatever you are going to recalculate is called as modified NPV and modified IRR. Not really important from exam point of view, but extremely important from an understanding point of view to understand NPV and IRR from a practical analysis point of view. So for the time being, what you will do is this reinvestment and all will come in some time. You just note this part, that is, first project gives so much of NPV, IRR, second project gives so much of NPV and IRR. I don't want to spend time on that. Calculate first. Working note 1, calculation of NPV and IRR of, or you can even note down the answer directly. Calculation of NPV and IRR of project X. You can prepare this table and then project Y. NPV and IRR of project X. Just do the calculation. I don't want to spend time on IRR calculation, NPV calculation. To do IRR, you need one positive, one negative, all of that remains same. Yeah, any doubts? Yeah. No, so higher IRR is second. Correct. No, from IRR point of view, Y is better.
They're asking how can it be helping in decision making? That is what
I have two IRR, no? 20.
The doubt is, we understand that higher the NPV, better the project because my inflow is more than my outflow.
Correct.
I'm asking how is IRR an indication of that is it better?
So every technique, so payback says whichever has a better, lower payback, that is better. So like IRR is a technique which says that, so if I see what is IRR is return which you earn. So I ask you a question, do you want to earn 22% return or 26% return? 22% return or 26, which return you want to earn?
But IRR is the rate at which if my inflow
initial or outflow.
Correct. So that is the return you are earning. So technically, for example, I'll give you an example. You invest 100, okay? You get back 110 after a year. What return did you earn? Sure about it? Let me do discounting at 10% now. You will get 0 NPV. You told me that you got a 10% return. So IRR is basically the return which you are earning. So you told 10%, 100 and 110. I did discounting at 10% now. I get 0 NPV. So IRR is the return which I am earning. So between two projects, if I have to choose, see, some people will say I will go by IRR. Some people can say I will go by NPV. Now there is a conflict. I have to resolve this conflict. Why is this conflict happening? This conflict is happening because there is a cash flow disparity. When I say cash flow disparity, in project 1, you have lower inflows in the initial years and higher inflow in the later years. In this project, you have higher inflow in the initial years and lower inflow in the later years. Because of this disparity, there are three types of disparity. One is called as life disparity. Life of the two projects is different. You do EAB/EAC. Then there is a cash flow disparity, which is this. Then there is a size disparity. Size disparity is initial you gave 110, no, this side. This side the project could be 220. Double value, obviously it may have double NPV. So the point is NPV is an absolute measure. If I invest 1 crore and I earn 1 lakh rupee NPV, and if I invest 1 lakh and get 90,000 NPV, NPV will say go and do 1 crore project. NPV is not bothered about whether you are investing 1 lakh or 1 crore. NPV will just say go and invest 1 lakh because that is a higher NPV. It's just an absolute measure. It doesn't take into consideration what amount am I investing to get it. So in this case, that problem is not there. Life problem is also not. There is a cash flow problem. Now how are we resolving is what you are going to see now. Any doubts till now? Any doubts in this? Okay. Now I'll again, some part of it I'll be doing it, some part I'll tell you to calculate it. Whenever there is a need to calculate, I'll let you know. Working note 2 will be calculation of modified NPV and modified IRR of project X. I'll do X, I'll tell you to do Y. They have given some reinvestment rate. What is the reinvestment rate they have given?
14%.
At reinvestment rate of 14, and then they have again changed it and made it as 20. Now listen. Calculation of modified NPV and IRR at 14%. Now see, any project which I do, I'll be earning something in between. Logically speaking, I need to put that money in some project. Nobody is going to keep cash idle. Just because I've got it, and if I keep it as idle, my returns will fall down drastically. If you remember, in bond valuation, we done a problem where it said reinvestment is not possible. The returns crash like anything there. So I have to reinvest the money which I get. Now listen. Reinvestment period. This cash flow, you please keep listening, I'll tell you when to note down. This, what I receive in the first year will be reinvested for 3 years. This will be reinvested for 2 years. This will be reinvested for 1 year, and this you get immediately, no concept of reinvestment. You will have something called as future value factor at 14% because our reinvestment rate is 14%. 1.14 power 3, 1.14 power 3, power 2, power 1, power 0, 1.14 power 3, power 2, power 1 and power 0. These are the numbers I'll get. Maturity value. Now, if I'm going to reinvest at 14%, if I'm going to reinvest at 14%, I will invest 110 on day 0 and get back 224.91 after 4 years. That's all, nothing will come in between. This is what was done as realized YTM in bond valuation. We had done this as realized YTM. I will invest 110 and get back only 224.91. Wait. Why am I doing this is, now then I will do this. Same calculation, I will have to again do NPV and this. In this, nothing you get, nothing, and you get 224.91. 224.91. Like this, there will be a number for the other project also, like 224.91. These two are called as modified NPV and modified IRR, 19.58 and 43.61. Wait, 19.58 and 43.61. If I go to second project, can you tell me the cash flows of the second project? Just a minute, I'll copy it. 71. This, if I assume reinvestment, I get 222.77. Let me just explain this and then I'll tell you to copy. Now if you see, NPV as well as IRR will be better for one project only. Both NPV and IRR would be single project, would both the techniques will prefer single project. If you see IRR, this project is better. If you see NPV, this project is better. In fact, I don't even need to calculate NPV and IRR. I can find only with the cash flow itself. 224 vis-a-vis 222. That itself will tell me, because initial outflow was 110. So the 224 and 222 itself can answer which is going to be better. Wait. If you see, initially IRR was 22. Why did it come down? Is your reinvestment is happening at 14%. You are reinvesting it at a lower rate. Why did NPV go up? Is NPV is going up because cost of capital is 10, but you are reinvesting it at 14. NPV technically assumes reinvestment will happen at 10%. IRR technically assumes reinvestment will happen at 22. If this was 24%, then IRR also would have gone up. IRR also would have gone up. So now what we are going to do is, listen, calculation of modified NPV and modified IRR with reinvestment at 14%, year, cash flow, reinvestment period, future value factor and maturity value. You are going to do this for both the projects. I don't want you to copy that. You will copy again this. I don't want to spend time in calculating NPV and IRR. IRR will take a lot of time. So let's write now. Calculation, now write project X, right? Project X. The heading is already written, I think. Calculation of modified NPV and modified IRR with reinvestment at 14%. Modified NPV and modified IRR with reinvestment at 14%. With reinvestment at 14%. Project X, underline that. Project X, underline that. Project X, underline that. Year, cash flow, year, cash flow, year, cash flow, reinvestment period, year, cash flow, reinvestment period, reinvestment period, future value factor at 14%, future value factor at 14%, maturity cash flow, future value factor at 14%, maturity cash flow. Now write year 1, 2, 3, 4 and the cash flow, 1, 2, 3, 4 and the cash flow, 1, 2, 3, 4 and the cash flow, one, two, three, 4 and the cash flow. The reinvestment periods are 3, 2, 1, 0. Reinvestment periods are 3, 2, 1, 0. Write the factor and write the maturity value. The maturity value is 224.91. Calculate a similar maturity value for the other project. Calculate a similar maturity value for the other project. Year, cash flow, reinvestment period, maturity value. Get the maturity value for both the projects. Any doubts in these numbers? Okay, now you can copy this modified NPV and IRR table. Copy the modified NPV and IRR table. Basically, calculating NPV and IRR with this is called as modified NPV and modified IRR. I want to spend time on doing this calculation. If I do NPV and IRR with this cash flow, it's called as modified NPV and modified IRR. If we do with this cash flow, it is called as modified NPV and modified IRR. You assume a reinvestment rate and then calculate the NPV and IRR. That's called as modified NPV and after completing this, you do a 20% reinvestment rate changes. I'll give you the answer to NPV and IRR alone. Cash flow, you do the calculation. Do a reinvestment at the rate of 20% and again do the calculation. The basic thing is both NPV and IRR will prefer the same project at a modified level. your maturity value will be 241 and 248. Second project will be better both in terms of NPV and IRR. You can copy the second table. Maturity value you should get it. IRR I want you to do because it will take a lot of time to compute IRR. $241 and $248, and we net get to know 22.57 is modified IRR, 59.58 is modified NPV for the second project, and that is better. NPV as well as IRR, the second project is better. We assume a reinvestment rate of 20%. Whenever I do a reinvestment rate and calculate, it's called as realized IRR, modified IRR. Can we proceed? Any doubts on this? 241 and 248. Obviously 248 will turn out to be better. Done? Okay, this is as far as the basics is concerned. Second, our focus will be on something called as investment decision. Now listen, as far as capital budgeting is concerned, there will be two types of critical problems. One is investment decision, second is replacement decision. So topic 49 is going to focus on investment decisions. Topic 50 will focus on replacement decision. Replacement is selling an asset and buying a new asset in its place. Investment is making a fresh investment altogether. So we'll focus on this, and thereafter we'll go to something called as risk analysis, which is specifically started at final level, that was not at CA Inter. So whatever we are going to do is technically there at CA Inter, just that the problem will become complex at this level. Let's start with question 1. ABC Limited, an existing profit making company, is planning to introduce a new product with a projected life of 8 years. Equipment cost will be 120 lakhs, additional equipment 10 lakhs. At the end of 8 years, original equipment will have resale value, but the additional would be sold for 1 lakh. Working capital data is there. The company is subject to 50% tax. Change the sum of years digits method. I want to do this. Let's take it as SLM itself. SLM method, and taking 12% as appropriate after tax cost of capital should the project be accepted. Let it be SLM. Don't read the sub notes which are given, leave that, just go through the question. Let it be SLM method, ignore the sub notes which are there. Okay, we are going to do this problem in those 4 steps which we have learnt. Let's start doing them. Working note 1, initial outflow. Working note 1, initial outflow. Initial outflow. Particulars amount in bracket in lakhs, particulars amount in lakhs. Working note 1, initial outflow, particulars amount in lakhs, amount in lakhs. Point number 1, capital expenditure. Capital expenditure. What are the initial expense the company is incurring? 120 lakhs minus 120, capital expenditure minus 120. Point number 2, working capital. How much the working capital blocked? 15 lakhs. Initial outflow. $135 lakhs of outflow. Initial outflow 135. Capital expenditure, working capital, initial outflow is 135. Clear? Working note 2, in between flows. That is, throughout the project, what do we get? Working note 2, in between flows. Working note 2, in between flows. How many years is the project? 8 years. And if you see, the sales is not going to be same in 8 years. 20%, 30, 75, 50. So it's going to be different for different years. So we'll have particulars and 8 columns. Later on, you will learn that there's a possibility that I can club 3 to 5 together and 6 to 8 together. That we'll see later on. Initially, let's create separate columns. Particulars and 8 years. Particulars, year 1, year 2, 3. Particulars in 8 years. Okay, listen now. My working note 2 can start with revenues and few question. It can start with PBDT, PBT, PAT or CFAT. In this question, I have the capacity. I also know the utilization. So this is basically the sales. They said production and sales volume. And even if they give only production, it is assumed that sales and production are same. So I can calculate revenues because I have the selling price. So we will first start with revenues less whatever expenses are there. So point number 1 is revenues. Let's start with revenues. Revenues. The revenues for the first year is 4 into 20%. 4 is, we are doing in lakhs. 4 into 20% into 100 rupees. 4 into 20% into 100 rupees. 80 lakhs. 4 into 20% into 100 rupees. 4 lakhs into 20% into 100. Then into 30%. 4 lakhs into 30% into 100. 120. Then we have same for 3, 4, 5. Same for 6, 7, 8. 4 lakhs into 50% into 100 rupees. Revenues is done. Less, what are the expenses you are able to see? There's a profit volume ratio given, which means there is a variable cost. What is the profit volume ratio?
60%.
So variable cost is 40%. Less variable cost. Less variable cost. Variable cost is 40%. Revenues less variable cost. Variable cost is 40%. Then we have apart from this, what other expenses we have? There is a fixed cost and there is a advertisement expenditure. Now listen, fixed cost I assume it to be relevant because it is specific to the project is my assumption, and advertisement anyway will be relevant. Less fixed cost less advertisement cost, less fixed cost less advertisement fixed cost is 16 lakhs per annum, no, every year. What happened? Is likely to be 16 lakhs per annum. That is different. That is a that will not go and hit P and L. That will go below P and L. So we'll come to the equipment later on. Equipment cost will not come now.
Also, we assume that generally fixed cost is irrelevant except if it is mentioned.
Correct. Generally, it's here. So see, for example, in cost accounting, what will happen is they may give certain additional information. Here, the additional information may not be available much. Institute normally takes it as relevant because this is specific to the project. They are doing a project and relating to the project. Unless they use words like apportioned overheads, general overheads, corporate overheads, we normally tend to take it as relevant. The logic is this is specific to the project. So less variable cost, less fixed cost, less advertisement cost. Any other expenses given? Okay, now listen. I'll also subtract depreciation and directly write PBT. I don't need PBDT, that's just a line item, it will not serve me any purpose. Listen, wait. When it comes to depreciation, you have to think about two equipments. There is a original equipment, there is a additional equipment. There are two equipments. There is one original equipment and there is a additional equipment. Original equipment, what will be the depreciation per annum? Read it and let me know. Original equipment, what will be the depreciation per annum? Original. It will be 15 lakhs, 120 lakh minus 0 salvage value divided by 8 years. 120 minus 0, because they say that we'll have resale value equivalent to the cost of removal. Technically it means 0 salvage value, there is no salvage value. So 120 minus 0 by 8. Additional equipment, what is the depreciation? Additional, what will be the depreciation? How much? No. 10 lakh minus 1 lakh of salvage value divided by 6 years. You buy it at the beginning of the third year, so you will claim depreciation even in the third year. So original equipment is 15 lakhs, additional equipment is 1.5. So my depreciation is 15 for the first 2 years, 16.5 for the last 6 years. 15 for the first 2 years, 16.5 for the last 6 years, and get PBT. 15 lakhs for the first 2 years, depreciation is 15 lakhs for the first 2 years and 16.5 from third year onwards. 15 lakhs for the first 2 years, one of the year it is negative, other years are positive. Profit before taxes negative 13, positive 26, 137.5, 137.5, and the last 3 years is 83.5. Technically I could have clubbed 6, 7, 8 together because it is same number. Any doubts till now? Okay, now listen. What is the tax rate given in the question? Listen. Now tax for year 2 is this into 50%. Wait. First year alone, what is going to happen is there is a loss. On loss, you are going to save tax. On loss, you are going to save tax, and it is also clearly indicated in the question. So this loss will be set off against some other profits of the company, and because of which what will happen is the taxable income will come down, and automatically the tax payable will come down. There are some other businesses which the company has, on that anyway it has been making profits. So the formula remains the same. It is minus of minus, it will become plus. It is technically minus 13 into minus 0.5. When you do minus, automatically it becomes plus. The formula is this into minus 0.5, that is the tax. I have to subtract this. So minus of minus will automatically become plus, and my PAT. Because of tax my loss comes down, other years profits come down. 1 year loss comes down, and in the other years profits come down. So do this, less tax at 50%, less tax at 50%. There is a loss. On the loss the company will save tax. Because of loss the company is going to save tax. Less tax at 50%, you get PAT. We will add back depreciation now. Any doubts on the tax adjustment? Because there is a loss, you are going to save tax, add back depreciation and get it as CFAT. Add back depreciation, we will get CFAT. Add back depreciation, get CFAT. Okay, now listen. After getting the CFAT, it can go through 3 changes. One, when I buy my original machine, I don't pay for the full amount. I may have to make a payment now. Second, I may buy a new machine. Third, what can happen is I can have an increase or decrease in working capital. So sometimes when you do business, more money can get blocked. If there is an increase in working capital, it is an outflow. Decrease in working capital is an inflow. There is a purchase of additional machine. So I have to write that less purchase of additional machine less purchase of additional machine. I don't write it before PAT, before PBT, because this doesn't impact tax. Revised, this is a balance sheet item, this is not a P&L item. Purchase of additional machine and revised to CFAT. Purchase of additional machine and revised to CFAT, 10 lakhs. Purchase of additional machine and revised to CFAT. Purchase of additional machine and revised to CFAT. Revised to CFAT. Any doubts on this? Clear? Can you proceed? Any doubts on this? There's a mistake done. What is the mistake? That is terminal flow. There's a mistake in the statement. There's a mistake in the table. There's a mistake in the table, I can tell you that. No, relevant. I'm buying a new machinery. No, why will it be relevant? Yes, that's the mistake. It will not be third year. It will be second year. I didn't want you to read the below note. In below note, I mentioned that. Now listen. When am I buying the machine? Beginning of third year. Finance doesn't worry about beginning, it worries about end. So you should not read that line as beginning of third year, you should read it as end of second year. You should have read that as end of second year. Wait, when I buy a original machine, I write it in year 0. Technically it is beginning of year 1. When you buy a machine, it's technically beginning of year 1. Nowhere we were bothered about saying that I should write it in year 1, because that's a year 0 outflow. Initial outflow, day 0 outflow, we write in year 0. But that's not year 0, that's nothing like year 0, it's beginning of year 1. We don't write beginning year cash flow, we write only end of year cash flow. So when I buy at the end of beginning of third year, from an analysis point of view, it's not beginning of third year, it's end of year 2. And if it was third year, then third year can't have depreciation. I also charge depreciation in the third year because I use the machinery for that entire year. So it is beginning of year 3, technically called as end of year 2, and we will have to write it in year 2. We will have to write this in year 2. Purchase of additional machine, end of year 2. Clear? Can you proceed? Any doubts on this? Working note 3, terminal flow. Working note 3, terminal flow. Particulars and amount. Working note 3, terminal flow, particulars and amount. Working note 3, terminal flow. It's always end of year cash flow. Finance assumes everything to happen at end of the year. Point number 1, recapture of working capital. Recapture of working capital. Whatever gets blocked on day 0, what is working capital is? Cash, debtors, inventory, all that. If you are winding up the business, you will collect it back. So how much is the recapture? 15 lakhs. Point number 2, net salvage value in bracket note 1. If it was a single machine, we would have done it here. There are 2 machines, so I'll have to do a separate working note for this. Net salvage value and total terminal flow. Net salvage value and total terminal flow. Note 1, calculation of net salvage value. Particulars old new. Particulars old new. Or you can, original and additional. Let's keep it as that. Original and additional. We bought an original machinery and then we bought an additional machinery. Original and additional. Original and additional. We will start with sale value less book value, gain slash loss, tax paid slash tax saved, and leave a line net salvage value. Sale value less book value, gain or loss, tax paid or tax saved, and finally net salvage value. This is an important calculation. A lot of times you end up missing this. The original machine was sold for how much after 8 years? Was sold for 0. Additional machine 1 lakh. Original machine was sold for 0. Additional machine was sold for 1 lakh. Now listen, book value is the original machine was bought for 120 lakh. First year what depreciation did we charge? 15. Second year 15. Third year original machine. 8 years you charge 15. 15 into 8, 120 is gone. Your book value is also 0. Listen, salvage value being 0 does not mean net salvage value will not be there. Sometimes there will be a book value because of which there will be a loss and you will save tax. So in this case sale value is 0, book value is 0, gain is 0, tax paid or tax saved is 0, net salvage value is also 0. Wait, additional equipment we bought for 10 lakhs, we started charging depreciation from the third year. How much was the depreciation? 1.5 lakhs. Every year we charge 1.5. So 1.5 into 6 is 9 lakh. So 10 minus 9, 1 lakh value will still be there in the books. 1 lakh value will still be there. Gain is going to be 0. Tax is going to be 0 and NSV is going to be 1. NSV is not 0. NSV is sale value minus tax paid plus tax saved. Sale value, listen. Your additional machine was bought for 10 lakhs. 1.5 lakh is the depreciation in the third year, 4th, 5th, 6th, 7th, 8th. After charging 6 years of depreciation, it has a value of 1 lakh. See, wait, listen for a minute. If you feel these two are same, that you can do in your mind. If you feel these two are same, then you need not show this calculation and you can directly write salvage value as net salvage value because there will not be any tax impact. If you believe these two are same. When will these two be same? If I am following SLM method taking salvage value into consideration. If I am not taking salvage value or I am using some other way, then it will not be same. Otherwise these two will be same, and if these two are same, we need not show this calculation. So show this, and net salvage value is 1 lakh. Net salvage value is 1 lakh. This is a terminal flow. The terminal flow is 16 lakhs. Net salvage value, sale value plus or minus tax. It's not a continuation of the format. That's why we have left a line gap in between. It's not a continuation. Otherwise, you'll write 0, 0, and 0. It's not a continuation of the format. Clear? Can we proceed? Any doubts on this? Working note 4, consolidation and calculation of NPV. Consolidation of cash flow and calculation of NPV. You can take the numbers from various years. Year 0 will come from step 1, 1 to 8 will come from step 2, and year 8 will have separate step 3 figure. It has positive NPV. We'll go ahead with the project. The NPV of the project is 136.06 lakhs. The important learning is, one is tax saving part, second is that end of year cash flow, beginning of year cash flow if they give, how do we treat that? step 2 plus step 3. Step 2 is 58, step 3 is 16. You have to add that. You get an NPV of 136.06 lakhs. The NPV is 136.06 lakhs. Can you proceed? Any doubts on this? Okay. Let's go through question number 2. Please go through question number 2. We'll again have some key learnings here. Go through question 2. Okay. I'll first explain the concept which you are going to learn in this. Okay. Till now I've been telling that finance considers that cash flows will happen at the end of the year. But the problem is, in a real practical world, my entire sales is not going to happen on December 31 or March 31. It happens throughout the year. It will be happening every month. So we will have two types of cash flow. One is uniform cash flow and second is end of year cash flow. Uniform cash flow will be discounted with this rate. End of year cash flow will be discounted at this rate. So you are going to do your step 1, step 2, step 3. After doing the step, you will have to bifurcate that into end of year cash flow and uniform cash flow. Now end of year discount rate is something which you know, 1 divided by 1.25. What is uniform cash flow discount rate is? If it's 25%, it would mean 2.08% for a month. So technically what they do is 1 divided by 1.02083. This is for the first month. Second month will be this divided by 1.0283. Third month, fourth month, you like this you do for 12 months. After doing for 12 months, if you take an average of this, that average will be equal to this number which you see here. So that is what we technically do. The discount rate in this question is 25%. Just a minute. 1.02083. Okay, it's 11. Just yeah, this average. How come it's, just give me a minute. Okay, sorry. Yeah, if you take an average of this, the average number will turn out to be 0.88. The average is something which is visible here. So average, logically speaking, this is a right discount factor to take rather than taking a discount factor of end of year, because practically it's not that my cash flows will happen at end of the year, but for simplicity's sake, all places you will take only end of year discount factor, which is 1 divided by 1.25. So in this problem, we are going to split the cash flows into one uniform cash flow and second end of year cash flow. After doing that split, then we will do analysis in the normal manner. Let's start now. Working note 1, initial outflow. Initial outflow. Initial outflow. Particulars amount. I'll complete the step and then I'll write two numbers, end of year or uniform. First is research expense. You see and tell me what should I write. Research in bracket sunk cost. For a sunk cost, you will not consider tax benefit also. That is also sunk. The tax benefit is something which they would have already taken. Research sunk cost 0. Research sunk cost 0. This is the discount rate. Which step will this be useful? Sorry, just a minute. This will be useful in step 2. This point. Again step 2. This. Whether relevant or irrelevant we will see later. Next point, what are they saying? It will be linked in step 1 as well as step 2 because they are paying it at the beginning of the year. Now listen, I'll write advertisement. How much is the advertisement expense? Listen, 1,25,000 and tax benefit on advertisement. It is my assumption whether I want to take it immediately or I will consider this as an item when I calculate my tax calculation for year 1. I can take it here or I take it in year 1. We will take this in year 1. As of now, I am just writing advertisement. The tax benefit of the advertisement will come throughout the year, uniformly across the year rather than being coming at the one stage itself. That's our assumption, right? Advertisement. Advertisement 1,25,000. What's the capital expenditure of the machine? 9,60,000. Capital expenditure is 9,60,000. This is my initial outflow. Initial outflow 10,85,000. Initial outflow 10,85,000. Initial outflow 10 lakh. I don't distinguish this because this is a one day figure. There is no distinction between end of year or uniform. This is basically on year 0. Step 2 we will have to distinguish. Initial outflow is 10,85,000. Any doubts on 1085? Working note 2, in between flows. In between flows. Initial outflow is 10,85,000. Particulars in 3 years. Particulars in 3 years. Okay, listen. I'm going to do calculation in the normal manner. Let me not worry about uniform, end of year, all this. All this will come later on. Let me first get the cash flow and then I'll see what is uniform, what is end of year. First revenues. 15 lakh, 25 lakh, 6 lakhs. Revenues 15, 25 and 6 lakh less variable cost 60%, variable cost 60%, revenues 15, 25 and 6, variable cost 60%. After variable cost, what we have? This 10,000 relevant, irrelevant? Relevant, irrelevant? That is relevant. Less, it will increase, they are saying, insurance and maintenance 10,000, insurance and maintenance 10,000, okay. Now listen, an important adjustment. What I will do for advertisement is I will write it like this: 125, 75, 60. The reason for doing this is income tax calculation will happen according to this. Later on I will do an adjustment on the change in years because it is made at the beginning of the year. That adjustment we will see it later. As of now I will write it like this. Later on I will remove this item. Later on we will remove this item. Why I am writing like this? Because income tax will say first year advertisement is 1,25,000. Whether you pay on April 1 or March 31 of that year, it is an expense for that year. So from a tax point of view, this is what will be done. We will remove this item later on. Less advertisement 1,25,000, 75 and 60. Correct. You can give. That's an alternate answer. You can give a tax benefit there itself, which means immediate tax benefit. I assume it's not immediate, it will happen throughout the year. There's somewhere they mentioned that uniformly over the year you get the tax benefit. You will not get it immediately. Just because you have spent 125, benefit will not come. Less advertisement 125, 75 and 60. What's the next item? Okay, you calculate the depreciation with this. You calculate depreciation and write it. Calculate depreciation. It's basically 1/3, okay, 33.33, 1/3. WDV method. Depreciation. What's the depreciation for the first year? What will be the depreciation in the first year? It is 9,60,000 divided by 3. Salvage value and all will not come into picture. 960 divided by 3. Listen. Whenever you are following WDV method, if you know the first year depreciation, which is 3,20,000, the the depreciation rate is 1/3 in this example. Second year depreciation will be 2/3 of this. That's how WDV works. If it is 1/3 is the rate, the second year depreciation will be 2/3 of the first year, third year will be 2/3 of the second year, and it goes on like this. It will go on like this. If the WDV rate was 20%, next year will be 80% of the first year, 80% of the second year, 80% of the third year, it will go on like that. So your depreciation is going to be this year number into 2/3. First year depreciation into 2/3. This into 2/3. Depreciation is 2/3 of the first year. In WDV method, it will matter on what was the depreciation for the earlier year. 2/3 of the first year. Depreciation. Any doubts on this? It's going to be 2/3 of the first year. The depreciation will become 2/3 of the first year. What's the next item they have mentioned? No, what is this? Okay. The new machinery will be installed in a factory area now occupied by equipment that can no longer be used. The company has already arranged for the removal of the old equipment at a cost of 10,000. What is this?
What it is for the new one, they have to remove the old one. So for that they are spending some 10,000, which is like a requirement, relevant carry.
Is it a relevant or an irrelevant cost?
It is relevant initially.
Read it carefully. The new machinery will be installed in a factory area now occupied by an equipment that can no longer be used. The company has already arranged. The company has already arranged for removal of the old equipment at a cost of 10,000. You buy this new machinery, old equipment will be removed. You don't buy this new machinery, again old equipment will be removed. In yes also you are going to remove the old equipment. In no also you are going to remove the old equipment, because I have already arranged for the removal of the old equipment at a cost of 10,000. The decision which I am taking, I am trying to buy a new machinery. See, the logical thing is I am going to buy a new machinery. Is there any link between buying the new machinery and removing the old machine? No link. There is no link, because the question has already said the company has already arranged for removal of the old machine at a cost of 10,000. If you want to interpret saying that no, I am buying this new machine and because of this the removal is going to happen, if you interpret it that way, then it is a relevant initial outflow. Then it's a relevant initial outflow. If your interpretation is that because I am buying, this removal is happening. The question somewhere mentions that new machine will be installed in a factory area now occupied by an equipment that can no longer be used. So somewhere I get to know that there is some waste space available in the company, and this waste space they were trying to vacate it by removing that old machinery. So this becomes an irrelevant cost. Clear? Any doubts on this?
We are purchasing the asset capex in the year 1, right? The 9,60,000. So for that year also I will be incurring some insurance.
Depends. So how, if you want to say that it is happening at the beginning of the year, then I'll go and take it in the step 1.
For 9,60,000 I will be adding the 10,000.
Yes, yes, obviously it will go to step 1. Here it's just not only mentions insurance, it also mentions maintenance. So I assume that will happen uniformly over the year.
That is fine. It will be happening first year, second year, third year, that is fine. Apart from that, even in the beginning of the year.
No, it cannot be additional for 1 year. No, you cannot assume 4 years of calculation. Why will it be 4 years? Insurance will be benefit for 1 full year. No,
Yeah.
the only thing is it 1, 2, 3 or is it 0, 1, 2? Does it happen in year 0, year 1, year 2, or it happens in year 1, year 2, year 3? What is the use of this line? Relevant, irrelevant, and if relevant, how much?
It is 15,000.
The new product will be stored in a company owned warehouse. The company has been trying unsuccessfully to rent the space for 25,000. Several offers have been rejected, the highest rent being 15,000 per year. Now listen, because I am going to manufacture this, I lose a rent of 15,000. I don't lose 25,000 and all. I've been trying unsuccessfully to rent it for 25,000. What I lose is only 15,000. If I suddenly say that we are not doing this project, I may rent it out for 15,000. I may decide to rent it out for 15,000. Any doubts on this? So let's rent 15,000. Let's rent 15,000. Relevancy test will happen only through a yes or no analysis. If you try doing that, you will get to know. you get PBT, PBT, what was the tax rate given? 50%. Less tax PAT, PAT number is 65,000, 3,43,333, 6389. Okay, now listen. Listen for a minute. Listen. We add back depreciation. Listen. We add back depreciation to get CFAT. In this question, I not only add back depreciation, I also add back advertisement. Why did I write advertisement? Just to calculate tax. Why do I write depreciation? Just to calculate tax. So just like we wrote depreciation, we also wrote advertisement. I am done with my tax calculation. Let me add it back. Add it back and write CFAT. Some adjustment will still happen. Add it back. No, even for the other years, I'll explain it. Because what you have done is we have written 75,000 in year 2, but that is beginning of year 2. Technically, it becomes end of year 1. So I add it back. We are adding this back. Adding back depreciation, adding back advertisement. I'm adding back advertisement, adding back depreciation. Now listen. This is uniform throughout the year. Again uniform, not uniform, and I have kind of removed this from my cash flow. I added and subtracted, so kind of removed it. This is not a cash flow. Uniform. Tax is also uniform. The question has said that the company pays tax as and when it earns the income. So what happens is the CFAT which we have calculated is uniform CFAT. That is, it is not 5,10,000 in 1 year. It's every month divided by 12. Wait. End of year CFAT. End of year CFAT is in the first year you pay advertisement of 75,000 beginning of year 2, and this is 60,000. These three numbers are uniform across the year. you receive it uniform throughout the year, and this end of year CFAT is nothing but beginning of year 2 is end of year 1, beginning of year 3 is end of year 2. Why I am segregating these two cash flows? 5,10,000 will be multiplied with a different number and 75,000 will be multiplied with a different number. There are two types of cash flow, one which you receive every month and one which you pay only on a specific date, on a single date. So in this case, advertising of the new product will total 1,25,000 in the first year, 75,000 in year 2, 60,000 in year 3. These are incurred at the beginning of the year. They are incurred at the beginning of the year.
So ideally the total first year I spent 2 lakh for advertisement.
No. That is year 0. No, this is year 1.
Year 0 is nothing but day 1, right?
And this is year 1 is day 365.
Yeah, so day 1 and day 365 comes in the same year.
Right, so technically it is day 366 rooted to day 365.
Yeah, so ideally if that was the case, if you are assuming that beginning of the year, which is nothing but end of year 1, so ideally 2 lakhs my total.
No, not because I didn't consider tax benefit that way. It is two separate years only. Why I write like this is, it doesn't really matter whether it's March 31 or April 1 from a discounting point of view. It's only from a discounting point of view I have to write like this. It is not that advertisement is 2 lakh in the first year. It's not. It's 125 only. See, the reason why we are segregating cash flows like this is we have two different discount factors. One is uniform discount factor, which is more logical one. Practically you will have uniform cash flows only. Nothing is like end of year. I cannot be doing a sales on one single day. So finance assumes everything to happen at the end of the year. That is more for simplicity sake. Any doubts on this? Why this distinction is, this will be multiplied with 0.88, 0.69 and 0.54. The other one which you see end of year, this will be multiplied with 0.8, 0.64 and 0.51. Any doubts on this? Any doubts on this? I am more interested in the concept clarity rather than the calculation behind it. If you have clarity on the concept, I move to the step 3. Every step I will have to distinguish. Step 1 and step 3 there is no distinction. Step 1 is end of year only. Step 3 is also end of year only. The step 2 alone you will have to distinguish between uniform and end of year. Any doubts on this? Step 3, terminal flow. Working note 3, terminal flow. Terminal flow. Working note 3, terminal flow. Particulars and amount. Working note 3, terminal flow. Particulars and amount. Particulars and amount. Working note 3, terminal flow. Let's write sale value less book value gain/loss. First let's capture sale, either it's a gain or loss, we'll capture accordingly. Sale value less book value. You try doing this terminal flow calculation. Sale value less book value.
tax savings.
What is the sale value?
Sale value is 1 lakh.
Okay. Book value?
2,84,473.
9,60,000 minus the depreciation for the 3 years. 9,60,000 minus the depreciation for 3 years. 284,445. Capital loss. Capital loss. Tax saved. Book value is original cost minus the depreciation for the 3 years. Minus the depreciation for 3 years. Original cost minus depreciation for 3 years. You have a capital loss, there's a tax saved, and we get net salvage value. Any doubts on this? Can I proceed? 50% of loss. 50% of the loss, you save tax and you get the net salvage value. Any doubts on this? Next, working note 4. Working note 4. Computation of NPV. Working note 4. Computation of NPV. Computation of NPV. Listen for a minute. I will have something like this. Year cash flow will be split into uniform end of year, PVF uniform end of year, DCF uniform end of year. For the first year, it is both are one. It's technically there's nothing like uniform or end of year. So you will have to distinguish the cash flow between uniform cash flow and end of year. Year 0 you want to write in uniform, write in uniform. You want to write in end of year, write end of year. Doesn't really matter. Every other cash flow I'll have to properly distinguish. Uniform end of year. The discount factors are different for both. Finally, we'll put an overall total and then get to the answer. Year cash flow uniform end of year, PVF uniform end of year, DCF uniform end of year. Cash flow uniform end of year, PVF uniform end of year, DCF uniform end of year. What is the initial outflow? 10 lakh. I'm writing it in uniform. I can write anywhere, it doesn't really matter. 10 lakh 85. First year uniform was 5 lakh 10 and end of year was negative 75,000. Second year uniform is 631, end of year is 60,000. Third year uniform is 208. Third year uniform is 208. This 192 is a single day cash flow, end of year. You will sell the machine and get this. Uniform end of year. The overall NPV is negative, we'll reject the project. The overall NPV is negative. We are just distinguishing the cash flows uniform and end of year. Distinguishing it as uniform and end of year. Uniform cash flow and end of year cash flow. Finally, we'll reject this because the overall NPV is negative. Clear? Correct.
So, what is the difference between the uniform cash flow?
So, in a practical world, what cash flow happens is uniform. Uniform means every month we get something, no? Finance says everything will happen on December 31, which is not logical. Every cash flow, no? For example, if I am doing my business, every month I will make profits, no? Every day there is a sales, every day there is an expense, every day there is a profit. So, I make profits on a daily basis. So, I cannot say that everything comes on the last day of the year. That is why uniform cash flows came into picture. Logically speaking, this is how we should do discounting, but from a problem solving point of view or a project analysis, we do only end of year. Even in real world, we do only end of year analysis. We do end of year analysis and then complete it. Clear? Any doubts on this? We will take a break of 5 minutes and then continue. Okay, let's go through question number 3. Please go through the question. Let's do question number 3. Okay, let's start putting this data in those 4 steps. Step 1 is initial outflow, in between flow, terminal flow, and then finally we calculate NPV. Working note 1, initial outflow. Working note 1, initial outflow. Particulars amount in millions. Let's do the problems in millions. Particulars amount in millions. Amount in millions. Particulars amount in millions. Amount in millions. What are the initial outflows we see? Which one? Okay, point number 1, equipment. Equipment minus 100. Equipment minus 100. Point number 2, what else is there? Building minus 100. equipment 100, building 100, working capital, let it be cash, that is also money blocked only. Even having cash is money blocked because that is dedicated for that project. How much is the working capital? 10 million. Equipment 100 million, building 100 million, working capital 10 million. What else is there? Okay, there is a research and development of 25 million. The firm has already paid 25 million for research and development of the project. Point number 4, R&D in bracket sunk cost. R&D in bracket sunk cost. This is 0. R&D in bracket sunk cost is 0. Ideally, I should have considered one more expense. I am not able to because they have not given value. This says the firm uses vacant land for the new attraction and it has no alternative use of the land for the next 4 years. Though it does not have any alternative use, there will be a value for the land. So, indirectly what happens is missing out land in the analysis can reduce your NPV. How it is land, the value of the land is normally expected to only go up. So, because I am using it for this project, there can be some favorable impact on the land value also. So, logically speaking, I should have written something called as point number 5, land in bracket today's value, whatever be the value of the land, I would have written some value, and after 4 years again land comes back at some value. For the time being, I do not have anything on the land side, so we ignore it. This is my initial outflow. So, total outflow, I have an outflow of 210 million. Initial outflow is 210 million.
The vacant land is used for some other purpose.
Yes.
And for any rent they charge, then I will be taking it as
That is your in-between flows of opportunity cost.
So I'll be even including in the initial as well as
No, if it's you are considering an in-between, if you are going from a rent angle,
it will be sacrificing and
that's all, only rent will come. Working note 2, in-between flows. Working note 2, in-between flows. Working note 2, in-between flows. How many years is the project?
4 years.
4 years. Wait. Every year the revenue is going to be same. Wait for some time. Every year the revenue is going to be same, but still I will write 4 different years because of this. Because the depreciation is not going to be same for all the 4 years. If depreciation was also same, then I would have written only particulars and amount, that's all. No separate 4 years. Revenues will be same, expenses will be same, depreciation is the problem. Depreciation is not going to remain same. It is going to be different for different years. So, particulars and 4 columns. Particulars, year 1, year 2, year 3, year 4, have a year 5, you will need this technically, I will explain later. I will explain this later, but you will need a year 5 also. Particulars, year 1, year 2, year 3, year 4 and year 5. Year 1, year 2, year 3, year 4 and year 5. Why year 5 you will understand in some time. The project is only for 4 years. I am writing 5 years because of some reason. As we proceed, you will understand. Right? Revenues. What's the revenue? 400 for 4 years. Revenues is 400. Now listen. Cost for this revenue is 50% with 60% of paid in cash and 40% paid on credit for 1 year. My expenses is going to be 50%, but I am not going to pay the entire amount. So, whether payment happens or does not happen, I will see it later, because from a tax point of view, this is my expense from a tax point of view. Like advertisement was an expense, we did a after CFAT adjustment. In this case also, we will calculate CFAT and then we will say creditors, amount paid, amount not paid, some analysis will be done. But as of now, I will consider entire 50% as the expense. Amount unpaid will come somewhere in the analysis. We will see that in some time. So less expenses 50%. We have not paid the entire amount, we will see in some time. Less expenses okay. Before depreciation, I have one more item. What should I do with this? What is the use of this line? It's an opportunity cost. It's an opportunity cost. See, today Queensland, there's an amusement park. Assume they say that I'm going to open one more in some other part of Chennai. What will happen is the traffic, whatever people who were traveling till Queensland, some of them may say that it is anyway nearer to us this side. We will go to this Queensland rather than going to the other Queensland which is there. So the revenues of the other amusement park is going to come down. It's an opportunity cost. The important word there is after tax cash inflow. So because of this, what I will do is I'll first calculate CFAT and then deduct it. If it was a normal inflow, then I would have deducted now itself, because this is post income tax. So you cannot deduct it at pre income tax level. If it was as a result of the new project, the cash inflow from other amusement parks or the pre-tax cash inflow from other amusement parks, then I would have written less opportunity cost at this stage. I cannot write it at this stage because the loss is at a after tax level. So let me first calculate the after tax level. Able to understand this? Any doubts in this? The given opportunity cost is a post tax opportunity cost. Yeah.
There's like two ways to answer this question, but they ask the other amusement parks, right? So inherent limitation is that it's of the same things, right?
Yes, obviously this is, it is not that my competitor's amusement park, that they need not give. No, why am I bothered about it? And how will I get to know what is happening to other amusement parks? The logic is considering building an additional amusement park. So somewhere it's my own amusement park data is what they are giving here. Obviously other amusement parks will have a fall. When I am opening a new amusement park near to the other amusement parks, there will be an impact, but I am not bothered about that site. So what we will do here is less now depreciation on building, depreciation on equipment. They have given some percentages. In that percentages you put depreciation on building, it will be the same numbers as it is, because 100 is the cost. The depreciation given in percentage will be same as given in millions also, because it will be multiplied with 100. Profit before tax. Profit before tax. tax is at 34%, deduct, add back depreciation. Any doubts on the CF80 number? Get till CF80. There's no major adjustment till now. The only adjustment, the special adjustment which I want to discuss is on that expense which is not getting paid. Get till CF80, two adjustments to be done post that. Any doubts on this? Any doubts on the CF80 number? Okay, now listen. After CF80, less, I don't want you to write, listen for some time. One is that opportunity cost. We are losing how much they said? 20 million a year. Other amusement parks are going to have a loss of 20 million a year. That's opportunity cost. Wait, now listen. Add outstanding expense at end of year. Listen for some time. Add outstanding expense at end of year. I have not paid, less payment of last year outstanding expense. Sometimes this also has to be done. I have to pay for the last year outstanding expense. In the first year, what will happen is, whatever is the expense you see here, what percentage is not paid? 40% is not paid. So on my balance sheet, this will show us an outstanding expense. Next year also there will be an outstanding expense. Next year also there will be an outstanding expense. Next year also there will be an outstanding expense. But the point is, this outstanding expense which you see here, no, will be paid in this year. It will be paid in this year, because next year you have to pay that outstanding expense. The first year outstanding expense will be paid in the second year. Second year outstanding expense in the third year, fourth year and fifth year. That's why I had a fifth year. And my revised CF80 is, technically this adjustment has no impact on the second, third and the fourth year. It will technically have no impact, because if you see here, it is 148 minus 20. You add back 80 and subtract 80. Why you add back 80 is you did not pay the current year expense. Why you subtract 80 is last year expense you have paid in the current year. So technically second, third and fourth year has no impact. Second, third and fourth year has no impact. This is just knocking off. The real impact is this plus 80 gets knocked off in the last year. And the fifth year has a negative 80 ka cash flow. Fifth year has a negative 80 million cash flow. So first year you get a huge benefit on the cash flow side. Why do I get a huge benefit is, I have only 144 of CF80, but that increases to 204 because I did not pay. The rule was that I need not pay for the 1 year, I can pay it in the next year. So first year cash flow gets inflated, second year no impact, third year no impact, fourth year no impact. Whatever inflated cash flow happened in the first year will look like a negative cash flow for the fifth year. It will look like a negative cash flow for the last year. Any doubts on this? Any doubts on this number? So this adjustment you will have to do: outstanding expense at end of year and payment of outstanding expense of last year. Last year outstanding expense has to be paid.
Actually, the positive 80 we have considered for tax computation, so that's why we are adding back.
Which one?
Ideally, that 80 rupees
It's already considered, correct.
for tax, but since there's no outflow in the current year, we are adding back.
We are adding it back.
In the next year, the outflow will be in the next year for particular year one.
So this 80 is coming here. This 80 is again adding back because I did not pay.
That year outstanding.
We did not pay 80. Any doubts on this? Working note 3, terminal flow. Particulars, equipment, building. This is the similar adjustment what we did in the last problem. You see the sale value, you see book value and do the calculation. Okay, there will be a working capital also. I'll write that in some time. There will be a working capital also.
So what's the requirement of this work? The building will be placed in service in January.
The building is?
Will be placed in service in January. In point and stanza 2.
Building will be placed in service. I don't see any use of that. I don't know why that line is of no use.
So probably in case they would have asked like the beginning of the year is 1st of April and the end is 31st March and the building is placed in service is 1st of January. So depreciation for 3 months won't be to that.
No, I still don't see any impact of it. Maybe yes, what you say can work out. Depreciation could be for 3 years, 3 months, maybe. But if I take that logic, then 9th month only building cost has to be taken, not year 0. So I don't see any use of it. You see, is there any sale value of equipment and building? Subtract book value. What's the value of equipment after, is there any sale value of equipment? 0. Book value? 100 minus 4 years depreciation. This will also be 0. So everything is 0 for equipment. Equipment, everything is 0. Book value, sale value, both are 0. Building, what's the sale value? 110. The building value is going to be 110. Book value is 100 minus the depreciation for 4 years. Building? So it's, they are saying the value will increase to 110 million. Whether you sell it or you don't sell it, I'm not really bothered about it. From an analysis point of view, I say the building value is touched to 110.
So it's like something like revaluation gain.
Not revaluation. I'm saying if you want, you can sell it for 110 today. If you want, you sell it for 110. You don't want to sell, that's your wish. Now, I constructed an asset and that asset is worth 110 now. If you are selling it, great. If you are not selling it, great. From an analysis point of view, if I do this project, I'll get a building worth 110. Now, just because the company doesn't want to sell, that cannot reduce the NPV of this project, no? Because this project is giving this building also. And they are saying the building is worth 110. It could be because of any reasons. It could be because maybe in that area, the values have gone up. It could be because of XYZ reason. Logically speaking, I would have ideally expected the value to come down only. Building value should have come down rather than going up. So there is a capital gain, tax paid. There is a capital gain. In this case, there is a capital gain.
But until and unless if I sell, there won't be any capital loss or gain, right?
Again, assumption is you have going ahead and selling it. Assumption is you are going ahead and selling it. That 110 I can write only if he sells it. No, with these are all with an assumption that he is selling it 110. If he is not going to sell, that doesn't mean I have to put a 0 value. I cannot put a 0 value to this building. No. If you want, you sell it. You don't want to sell it, that's your wish. See, basically what I am trying to indicate here is, I am giving you an asset which can be sold net for 102 million. If you want, you sell it for 102 million. How 102? You sell for 110, pay tax of 7 million and get 102. You don't want to sell, that's your wish. I cannot tell somebody that you will have to sell it or not to sell it. That's company's wish. 100 minus depreciation of 4 years. Depreciation on building. 100 minus depreciation of 4 years. 4 years, all subtract. 100 minus 3, minus 3, minus 3, minus 3. You will get around 87, no? Depreciation of 4 years. So this is my net salvage value. On top of this, I'll have recapture of working capital. Now it's company's wish whether they want to sell it or not sell it. I am not getting into that part. See, it's with an assumption that you sell the building at 110. If somebody says, I am not going to sell it, that's their wish. Because they may find another use to this building. This is a year 4. Which one? Sale value minus tax paid. Sale value minus tax paid. Plus or minus tax, it can be plus tax saved. If you are paying tax, you subtract it. It's basically not a continuation of this format. Ideally, I should leave a line gap. It's not a continuation of this format. Net salvage value is 102 million and there is a recapture of working capital of 10 million. 102, and then there is a recapture. These are implied assumptions, not specific. Can you proceed? Any doubts on total terminal flow? Next, working note 4, calculation of NPV. The terminal flow happens in 4 years, but this is a 5-year project because of that payable which is there. Consolidate and calculate NPV. Which one? I didn't understand. How do we calculate that? Okay, that will come in financial services. I'll take you there. So the company can take up the project as it leads to positive NPV of 233 million. In this, the main concept was that creditor adjustment. The important concept was creditor adjustment and after tax opportunity cost. So every problem will have something or the other. Here we had after tax opportunity cost adjustment and also an adjustment on creditors. Any doubts on this? Can we proceed? Clear? Any doubts on this? Let's go to question number 4. Go through this question. Please go through the question. There are some extra information, just ignore that. That was a practice problem, but we'll do it in class. Go through question 4. Ignore the extra info of the next page. Okay, now coming to this project, the company is planning to buy to purchase a mechanized sewage line. The cost is 20 lakhs. If you see, the objective of this capital expenditure is to reduce cost. They are saying the present system is to use manual labor. You are provided the following information. I'll buy, this is my initial outflow, step 1. Depreciation is technically calculated only for 5 years because they have said 20% per annum straight line. 20% means 1, 2, 3, 4, 5. In 5 years, it will become 0 value. No depreciation, I cannot claim, no, because it will get fully depreciated. The operating cost is 5 lakhs. This is normal expense, and the revenue is this. When you multiply these two, it is like revenues. Why it is revenues? Any cost saving is similar to revenue. There is nothing much in this question. That item will be treated as revenue. Let's start in those 3 steps. Working note 1, initial outflow. Working note 1, initial outflow. Initial outflow. Particulars and amount. Working note 1, initial outflow, particulars and amount, particulars and amount, capital expenditure. Point number 1, capital expenditure. What's the capital expenditure you see? 20 lakhs. Capital expenditure is 20 lakhs. Capital expenditure is 20 lakhs. Working capital 0. Initial outflow. Initial outflow. Capital expenditure 20 lakhs, working capital 0, initial outflow is 20 lakhs. Working note 2, in between flow. Working note 2, in between flow. In between flows. Okay, now listen. In this project, it's going to be every year the same number. the except differentiator is first 5 years there is depreciation, next 5 years there is no depreciation. So, we will call it as particulars year 1 to 5 and year 6 to 10. This is more because of the depreciation part. The question had said 20% SLM. 20% means in 5 years it will get fully depreciated. Year 1 to 5, year 6 to 10, particulars year 1 to 5, year 6 to 10, 1 to 5 and 6 to 10, year 1 to 5 and 6 to 10, point number 1, reduction in cost. Reduction in cost, whatever amount we are reducing, that's an income. Particulars year 1 to 5, year 6 to 10. How much are we spending on manual labor today? 20 lakhs. That's my every year revenue. Technically that is my every year revenue. 200% into 10,000 is the revenue which we generate. So reduction in cost is 20 lakh. Because of this machinery we are going to save 20 lakhs. Reduction in cost 20 lakhs. Reduction in cost 20 lakhs. Currently we are using manual labor. In manual labor 200 people are involved and we are paying 10,000 to them. So 200 into 10,000 is the current expense. Because I bring in this machinery, I will eliminate all the manual labor. I don't need the manual labor, and in place of manual labor the system is going to come in. So the present system of the company is to use manual labor for the job. This manual labor will now not be required the moment you shift. So listen, it's not that I exactly save 20 lakhs, I don't save 20 lakhs, less operating cost. What is the operating cost of the machinery? Okay, listen. I can write reduction in cost as directly 15 lakhs. If I write 15 lakhs, then I will not write less operating cost. I am writing operating cost now because that's the expense of the machinery. If somebody wants to write reduction in cost as directly 15 lakhs, then you are not going to write operating cost in your calculation. And we write only 1 year cash flow. I am not going to do into 5 and all, because this is the amount for every year. So we write reduction in cost 20 lakh, less operating cost 5 and 5, less operating 5 and 5, reduction in cost 20 lakhs, less operating cost 5 lakhs and 5 lakhs. What is the next expense they have given? That's all. Less depreciation, 4 lakh 0. First 5 years you charge depreciation, then no depreciation. PBT, you will subtract this and get PBT. Subtract this and get PBT. What's the tax number they have given? Any doubts on the PBT number? Tax is 35%. Any doubts on the CFAT number? Can you proceed? I'm not doing terminal flow calculation because the sale value will be 0, book value is also 0. We have fully depreciated the asset. So, there is no point in calculating salvage value. Directly calculate NPV. Initial outflow is 20 lakh, 1 to 5 is this amount, 6 to 10 is the next amount. Calculate NPV. One to 5 and 6 to 10. Any doubts on this? So, this is a problem on cost reduction. We saw that a new machine is getting installed and that leads to reduction in cost. Go through question 5. Okay, I'll start explaining this. Gretel Limited is setting up a project for manufacture of boats. The cost of the project is 300 lakhs. It has to decide whether to locate it in area A or area B. Area B is, I think, somewhere getting some tax benefits and other benefits from the government. If project is located in area B, it receives a subsidy of 20 lakhs from central. Besides, taxable profits to the extent of 20% are exempt. Project envisages a borrowing. The rate of interest is 12% in area A and 10% in area B. When I was explaining initial theory, I told we ignore interest cost, we ignore a borrowing, we also ignore a repayment of the borrowing. In this problem, I will consider all of this. The reason for that is the area A and area B has a different interest rate. The project has different benefits as for area A and area B. Listen. I can also ignore interest if I want. I can ignore interest in my analysis. Then you see this required return. This 15% can't be same for both area A and area B. In area A, the cost of debt is 12%. In area B, the cost of debt is 10%. So, the WACC calculation which a company has to do, when you do that calculation, area A and area B cannot have the same discount rate. If I am going to use the same discount rate, then I cannot ignore interest, because area B is maybe a backward area or something. It has some benefits on the government side, it has some benefits on the funding side, and if you see their cash flows is also bad. Area B is bad, but this bad cash flows may get compensated by a lower interest rate, may get compensated by tax benefit. We are not sure, we will have to do the analysis. So, in this problem, we are not going to ignore interest expense, we are also not going to ignore repayment of loan, we are also not going to ignore taking a new loan. So, the problem is going to be done on something called as equity shareholders angle, not long term funds angle, because financing is also one critical part in evaluating this project. The financing becomes a critical. Till now we did 4 problems, nowhere we got to know what is the funding mix. We didn't know whether it is debt funded, whether it is equity funded, what rate of interest, because all of that gets captured in this number. This 10% captures cost of debt, cost of equity, cost of preference, weighted average, everything is captured there. So, we were never bothered about that. In this question also, I wouldn't have been bothered if they give me a different discount rate for area A and area B. They have given a same discount rate, which is not logical for us to do. So, we are going to evaluate this under equity shareholders angle. Now, write point number 1. The rate of interest for area A, the rate of interest for area A and area B is different. Area A and area B is different. Full stop. The required return is given as 15%. The required return is given as 15%. With no difference in area A and area B's required return. With no difference in area A and area B's required return. With no difference in area A and area B's required return. With no difference in area A and area B's required return. Full stop. In this question, we cannot ignore interest expense. In this question, we cannot ignore interest expense. And hence the evaluation will be done. And hence the evaluation will be done from equity shareholders point of view. Evaluation will be done from equity shareholders point of view. Evaluation will be done from equity shareholders point of view. Working note 1, initial outflow. Working note 1, initial outflow. particulars area A, area B, particulars area A, area B, area A, area B, capital expenditure, we'll do the problem in lakhs, capital expenditure, in right hand corner write in lakhs, capital expenditure, what's the capital expenditure for area A? 300, area B is also 300, capital expenditure is 300, subsidy in which area we receive subsidy? B. My assumption is, you can write in bracket, assume to be tax free. This can also be taxable. If it's taxable, I'll have to pay tax on this. I'm assuming that this is a tax free subsidy. Assume to be tax free, 0 and 20. Loans taken, this is an inflow. Loans taken is an inflow. How much is the loan they are taking? 200. Loans taken 200. We will ignore normally loans taken. Initial outflow. From equity shareholders' point of view, outflow is only 100 lakhs and 80 lakhs. From their point of view, it's only 100 lakhs and 80 lakhs. From their pocket, only 100 lakhs and 80 lakhs goes. Working note 2, in between flows. Working note 2, in between flows. Let's do first area A, particulars in 10 columns. They have given different figures for all the years. Particulars in 10 years. Particulars in 10 years. The starting point is, in this case, EBDIT, earnings before depreciation, interest and taxes. That's the starting point, EBDIT, earnings before depreciation, interest and taxes. EBDIT, earnings before depreciation, interest and tax. Wait, so let's copy the numbers. Okay, minus 6, 34, 54. This is the EBDIT number, earnings before depreciation, interest and taxes. Okay, now listen. Listen for some time. The borrowing of the principal has to be repaid in 4 installments beginning from the end of 4th year. Now, what does this indicate is, first year, second year, third year, 4th year, you will pay interest on entire 200 lakhs, because your repayment will start at the end of 4th year. So, first year on 200 lakhs interest, second year on 200, third year on 200, 4th year on 200, 5th year you would have made repayment and the value comes down. 5th year you will pay interest only on 150, 6th year you will pay interest only on 100. 7th year you will pay only on 50, and 8th year onwards you don't pay any interest. The loan balance, these numbers which you see is the beginning of the year, it's not the end of the year. 200 lakhs is the loan at the beginning of first year, beginning of second year, beginning of third year, beginning of fourth year. At the end of fourth year it will touch 150. It will touch 150 and beginning of fifth year will be 150. You are paying your repayments from the beginning of, it's starting from the end of fourth year. The repayments start from the end of fourth year. So listen, interest is for the first year 200 into what rate they have said? Listen for a minute. 200 into 12%. Second year also same. Third year also same. Fourth year also same. Then you repay and then it becomes 150 into 12%. Again you repay 100 into 12%. Again you repay 50 into 12% and thereafter no interest. Interest is first 4 years 24, 24, 24, 24, 24 and then it's 18, 12, 6, 0, 0, 0. EBDIT less interest 24, 24, 24 for the first 4 years. You pay principal at the end of fourth year becomes 150. You further pay becomes 100. You further pay becomes 50 and then finally it touches 0. Any doubts on the interest part? Less depreciation. Principal part will not write it now, that will come after tax. Principal will come after tax. Depreciation is how much? SLM 30. 300 lakh of asset, depreciation is 30. Profit before tax. Profit before tax. Wait at that stage. Profit before tax. We pay interest on entire 200 for the first 4 years and thereafter it comes down. Okay, now listen. Gretel Limited is setting up a project for manufacture of boats, something they have mentioned. The tax rate given in the question is 50%. Now I have two assumptions. That problem, it was an existing profit making company. So whenever there is a loss, we consider tax saving. I'll tell you what institute has done, which is logical only. One, I can say there is a tax saving on that 60 lakh. Second, I can say it gets carried forward and set off against future profits. Institute has taken that rule because it's a new project which they are setting up and it's not an existing profit making company. Listen, zero tax, listen. Carried forward losses negative 60, carried forward losses negative 80, carried forward losses negative 80, carried forward losses negative 60, carried forward losses 0 and thereafter I will pay tax. Listen, it's not necessary that it has to be 60, it could have been 80 also. It could have been 80 also. If it was 80, what I would have done is, I would have added like this, the taxable income in that 80 is only 20 lakhs. The taxable income in that 80 would have been 20 lakhs. Why 20 lakhs? Because minus 60, minus 80, minus 80, minus 60 plus 20, on that 20 I have to pay tax. On that 20 I have to pay tax. In this question I reach exactly 0, so I don't pay any tax, and on these amounts I'll start paying 50% tax. We will pay tax on the last 5 amounts which we see. Initial 5 amounts I don't pay any taxes. The assumption is it gets carried forward and set off against future profits. It gets carried forward and set off against future profits. Gets carried forward and we set it off against future profits. Add back depreciation, less principal, You consider it accordingly and write add back depreciation less principal. Add depreciation less principal. Principal is paid in which years? So 0, 0, 0, 4th, 5th, 6th, 7th. This will be the CFAT, which will directly go to the NPV analysis. We'll take this to the NPV analysis. So first year is negative, thereafter it's every year positive for area A. First year is still negative and thereafter it is positive. Any doubts in area A statement? Let's do area B, similar statement. Area B. Area B, let's do a similar statement. Same format, it will be same format, some adjustments here and there will be. Area B area B, EBDIT is given. Minus 50, 10, 20, 45, 100, 155, 190, 230, 330. EBDIT minus 50, 10, 20, 45. Okay, coming to the interest part. What's the interest part? 10%, so 20, 20, 20, 20. For the first 4 years, you will pay on the entire amount. Thereafter, on 150, on 100, on 50, 20, 20, 20, then 15, 10, 5, 0, 0, 0. Okay, depreciation is a little tricky, I'll explain it. Any doubts till this? Okay, that subsidy which has come, it can be treated in two ways. One, you say it's a subsidy against the fixed assets and the value of the fixed asset comes down. It can be treated that subsidy is against the fixed asset and you will reduce the fixed asset. Subsidy could be not against the fixed asset, but it's promoter's contribution or it's government's contribution. Then it doesn't get netted off against the fixed asset which is there. The subsidy can separately be in the reserves and surplus side. The subsidy can also be netted off against fixed assets and you charge a lower depreciation. You will have to write a note on that. Depending on your assumption, this can be 28 or 30. It can be 28 or it can be 30 depending on the assumption. If I say subsidy has to be netted off against the fixed asset, then I can charge depreciation of only 28. If I say subsidy will not be set off, I am assuming it will not be set off, then I can treat it as minus 30. Let us take it as minus, okay, let us take minus 28 itself. Take minus 28. Any assumption is fine, any assumption is fine. My assumption is that subsidy will be set off against the fixed asset. The subsidy will be set off against the fixed assets. Subsidy will be set off against the fixed asset. Okay. The subsidy will get set off against the fixed asset and will charge only 28 lakhs. What will be charged is only 28 lakhs. Any doubts till now? We can treat it as 30 as well, both are fine. Okay, now listen, listen for some time. 2 points. One, they are saying the taxable profits to the extent of 20% are exempt for 10 years in area B. So, there is an exemption of 20% of the profits. Now, keeping this line aside, let me not worry about that line. First, let me see what is the loss. 98 plus 98, 196 loss. If there is a if there is a 20% exemption for gain, there will be 20% exemption for loss as well. Technically, both will have a 20% exemption. Wait, my loss increases to 234, loss increases to 262, loss increases to, reduces to 260, reduces to 198, reduces to 76, and I have a profit of 86 lakh in the 8th year. I have a profit of 86 lakhs in the 8th year. Any doubts till now? 86 lakhs in the 8th year. Now, two ways of treating it. One, you can say in this 86 remove 20%. In this 86 remove 20% because there is an exemption to the extent of 20% of taxable profit. My taxable profit is only 86 lakhs, so I can remove 20% out of that. After removing the 20%, that is, you have 86, you remove 20%, you are left with 68.8. On this, you pay tax at the rate of 50%. On this, you pay tax at the rate of 50%. Or you change your tax rate itself to 40%. What is 40% is? Effective tax rate. 50% is the tax rate. Exemption to the extent of 20%. So, logically speaking, my taxable rate is only 40%. 50% is the tax rate. Exemption is 20%. So, 50% into 1 minus 20%. The effective taxable rate for me is 50% into 1 minus 20%. I can calculate 80% taxable profit and apply 50% on that, or directly apply 40%. Directly apply 40%. Mathematically both are same. Mathematically both are same. In real world, you may have to show it like this. You will say profit 86, exemption 20%, taxable profit 68, tax is 34. Instead of showing it that way, I am going to straight away show 40%. Nowhere we are going to write anything. What we are going to do is let it be taxed at 50% itself, 0, 0, 0, 0, 0. In this year, the taxable profit is 86. What we will do is 86 into 40%, 86 into 40%, or it's 86 into 80% into 50%, 86 into 80% into 50%. So, I straight away write into 40%, this year straight away into 40%, and last year again into 40%, last year again into 40%. Clear? Any doubts on this?
Here we got PBT.
Correct.
Tax that is like for revenue for 100%.
Hmm.
We included another
You can do any way you want to. That's what. So you are coming back to this. You say you are going to show it like this. Show. You can show it in any ways you wish to show. The point is, when you subtract 20%, when you do your calculation later on, when you do CFAT, don't say that this is the pattern, I'll do CFAT based on that. That will become wrong, because this if you reduce 20% from it, that's only for the purpose of tax calculation. Now you end up reducing 20% and you bring down your PAT, that's wrong.
So again, I'll be adding depreciation. I'll add the depreciation to normal PBT.
Add depreciation, you will have to add that 20% back. So instead of doing all of that, let's take tax rate as 40% and do the problem, that's all.
So, but in case if I reduce to 20%, like in the year 8 itself, from year 8 I'm paying tax.
Correct.
So if I take 20%, even that will be from the year 8 only.
No, 1, 2, 3, 4 also you would have reduced your PBT, no? It would have reduced, no? You will have to add it back again, that also. So in your way you can do PBT less exemption 20%, taxable PBT less tax, PAT, add back depreciation, add back non-taxable 20%, and then you get to CFAT, which will become a longer way of doing it. So instead of doing that, straight away I take tax at 40%. Then you add back depreciation, do your principal adjustment, and then we'll start calculating NPV. We can write a note that the 20 lakhs, you can just write a note, the subsidy of 20 lakh will be adjusted against the asset. You will have to write a note, subsidy of 20 lakhs will be adjusted against the asset. Subsidy of 20 lakhs will be adjusted against the asset, and depreciable amount will be 280 lakhs. That's our assumption. Depreciable amount will be 280 lakhs. This project has negative for 5 years. Okay, it is 76, sorry. No, 86 only. You will have to go to the positive number. 86, year 8. Till year 8. There is no terminal flow. We will calculate NPV, computation of NPV. you'll have to consolidate and calculate NPV. So after calculating NP, we'll decide area A and then go ahead. Let me know if there are doubts here.